Much, Rebecca, and welcome everybody. It's lovely to spend what here in Arlington, Virginia is a somewhat rainy evening, but to spend it with you. We're going to cover the topic of annuities, and there are a couple of sections that I'm going to divide the presentation into. I will keep an eye on the chat and try to answer your questions as we go along, but if I miss one, please feel free to resubmit it, or Rebecca will keep me honest. But we'll talk a little bit about FINRA because not a lot of people know about FINRA. And then basics of annuities, some considerations, top tips, and resources that you can use. And then if there are any questions that I don't get to, we can spend some time at the end with a Q&A. So with that, let's dive in. FINRA is, as Rebecca said, the Financial Industry Regulatory Authority. We are a nonprofit, non-governmental regulator of one important slice of the securities industry, the brokers and the brokerage firms that sell investments, stocks, bonds, certain types of annuities. Our whole mission is investor protection and market integrity. We are not the federal government, but we are overseen by the federal government. So we are not funded by taxpayer dollars, but instead by the industry that we oversee, kind of like the FDIC and the Federal Reserve Bank and other self-regulatory bodies. We write the rules that govern the brokerage industry. We also monitor the markets and we enforce the rules that we write and that other entities like the Securities and Exchange Commission write as they apply to broker dealers. And a big important thing that we do is we educate investors, and that's what my world is. So I'm excited to be here with you to talk about annuities. Now, I'm sure that some of you already know what annuities are, but let's go through some of the basics because I think that'll help set a baseline for people who might be newer to investing and are perhaps considering annuities or might have heard about annuities and want to know where they fit into their portfolio. I want to emphasize, as Rebecca said at the outset, that I cannot, as a regulator, provide any kind of investment advice. I can't endorse any particular product, type of professional, or investment strategy. But what I can do is give you the information that you need to know in order to make a wise decision and/or to get more information about your investments. So what is an annuity? In a nutshell, it's a contract. It's a contract between you and an insurance company. And the idea is that it will either pay you immediately or at some point specified in the contract in the future, a stream of income, an amount of money based on a number of parameters. Annuities come in a variety of flavors, and we'll talk about those. But really what they offer to investors is the potential for tax benefits and also a savings vehicle that, if you decide to annuitize, can provide an income stream when you retire. They vary by how and how much you pay for them, what you actually get, and who regulates the sales of annuities. FINRA regulates the sales of annuities that are securities, but we don't oversee straight insurance contracts. So a fixed annuity, for example, we would not regulate. But we'll get into that as we go through the presentation. But the bottom line is that an annuity is a contract, and it qualifies in some instances as an investment contract. But it's really an agreement, and kind of like many contracts out there in the world, when you've seen one, you've seen one. They can be difficult to compare sometimes. But let's talk about some of the key commonalities that you see with different types of annuities. They all have payouts. They all have methods that you use to buy them. And then there are the different types. So with payouts, you either, when you purchase an annuity, get an immediate payout. You basically give your money to the insurance company and they say, yes, starting this month we will be paying you on a regular basis. That's called an immediate annuity. But there's also a type of annuity that you can use as a savings vehicle, and it's called a deferred annuity. The idea is that you contribute typically over time to accumulate savings in the annuity, but you defer any kind of payout, any kind of stream of income. So those are considered a savings vehicle. And with both types of annuities, you can pay with a single payment or you can pay premiums over a specified period of time. Typically, immediate annuities involve a single payment, and typically deferred annuities involve the payment of premiums over time. That's not unusual in the insurance industry. But there are three main types, and I'm going to go into detail about each of those types. But there's fixed, variable, and indexed. And again, I'll go through what each one of those are. So a lot of annuities have commonalities, and the main commonalities across all types of annuities is that they offer tax-deferred growth. When you have a deferred annuity and you are saving in before retirement or for future spending through an annuity, the contributions that you make are typically pre-tax dollars. But the growth of those investments will be tax deferred. You don't pay taxes at the time that you earn the income. Instead, it's later. You have payout choices. They guarantee income. Now, many regulators, myself included, will say frequently, as loudly as we can, that there's no guarantee with investing. There's always risk with investing. And that's true. But with an insurance contract, the whole element is that the insurance company, as long as it remains solvent, will guarantee a certain amount of payback on whatever contributions you make. So the guarantee is as good as the insurance company itself. And depending on the type of investments that your particular annuity includes, there should be a stream of income, sort of a floor. But annuities can lose money, and it's important to recognize that. And I'll talk about the ways that they can lose money. They might have additional features like a guaranteed lifetime withdrawal benefit. There's an alphabet soup of different features that annuities might offer, but those features can be meaningful to people, like a death benefit, because with a lot of insurance products, you're paying for the guarantee, right? So you pay for that. You usually can't access your funds very readily. It's a different type of investment. It's not like buying a stock where you can liquidate your asset at any time. But paying for that, having, that extra cost gives you the potential for guaranteed income or a guaranteed return. There's always a trade-off. There's always going to be risk, but part of the feature of an insurance contract is that it provides insurance, kind of like your home or auto insurance, right? You pay your premiums and you might never get into an automobile accident where you need to make a claim. But you have that protection in case you do have some kind of loss. So there's a parallel there. They always involve surrender fees. There might be a period during which that fee is reduced or a period after which that fee goes down. But in order to access your money, you're typically going to have to pay to get your money back. And then they all have costs. You might not pay a typical commission to a broker for purchasing an annuity, but baked into the product itself or in some other way, you do pay for these kinds of products. So just be aware that that's something that's true of all annuities. I do want to talk for just a little bit about a complex concept called qualified versus non-qualified. Some annuities, this really gets to the issue of whether the contributions that you make, the investment that you make in an annuity are tax deductible or not. With a qualified annuity, which is often offered in the context of an employer-sponsored retirement plan, you receive an income tax deduction for contributions up to whatever the current IRS contribution limits are. And the money accumulates without any kind of tax liability until it's withdrawn, unless you take it before you turn age 59 and a half, and that's an IRS rule. But your contributions and your earnings, so your pre-tax dollar contributions and the earnings that those contributions make, the interest or dividends that they pay, will be taxed at your income tax rate, when you take the money out. And you do have to take them out by a certain date. They're subject to what's known as RMDs, which is required minimum distributions. And I'll talk about the different points in time when people who are subject to RMDs have to take money out of their investments. You see the concept of RMDs a lot in the context of traditional IRAs and also employer-sponsored 401ks or similar types of retirement savings vehicles. Most of the annuities that you'll hear about from financial professionals, your insurance agent, your broker, are non-qualified annuities, and that means that you're using post-tax dollars. So there isn't any contribution cap. The contribution limit for pre-tax annuity contributions is currently $23,000, the same as for an employer-sponsored 401k or 457 or 403b plan. But you don't have that contribution cap when you're purchasing a non-qualified annuity. You still are subject to that 10% penalty if you take your money out before you turn 59 and a half. But your earnings can accumulate tax-free, and they're only taxed when you take the money out. Couple of things to note, how they're taxed depends on the terms of the contract. So I'm going to emphasize that these things are contracts and you need to understand the terms. Some contracts specify that there's a last in, first out, so that the money that you're taking out or the contributions that were made in a certain period, the earnings that they have will be taxed or not taxed in a certain way. And some annuities are subject to what's known as an exclusion ratio, which is basically the concept that when you're taking your money out of an annuity, you're actually getting back some of the principal that you invested. And so there's some percentage that isn't going to be subject to tax because it's a return of your original investment up to a point. And again, with a non-qualified annuity where you're contributing post-tax dollars, no RMDs, no required minimum distributions apply. So let me just say a few words about the age at which you have to take these required minimum distributions. It has been changing because of legislation that Congress has implemented, known as the Secure Act and Secure Act 2.0. So basically, there's a concept called the RBD, the required beginning date, the date by which you need to take your first required minimum distribution. And that date is typically April 1st after a certain year. And for people who were born before July 1st, 1949, that age is 70 and a half years old. But some of the legislation that I talked about, the Secure Act and the Secure Act 2.0, that raised the limit, the RMD age. And so there was a period of time where, in fact, there's still some folks who will be taking their first RMDs this coming April 1st. But it's basically April 1 following the year that you turned age 72. So either 2022 or 2023. And it depends on when you were born. If you were born between July 1st, 1949 and December 31st, 1950. But if you were born in the decade, January 1, 1951 to December 31, 1959, your RMD age is 73. And so those folks, the first of those, the oldest of those among that crowd will be taking their first RMDs April 1st of next year. And then for folks that were born after on or after January 1st, 1960, at least for now, under the Secure Act, it appears that the age is going to be 75. If you don't understand RMDs and don't know when you're meant to take them, the most important thing that you can do is talk to a tax professional. And we're going to say that again because it's an important concept. I mentioned a lot of tax deferred income and tax advantages of annuities. Always talk to a qualified tax professional, a CPA or other accountant that you have worked with about the tax consequences of purchasing annuities, taking money out of annuities, or really any of your investment decisions. Regulators cannot give tax advice, but we can flag for you that there are tax consequences to the decisions that you make. So I mentioned that there were different features of annuities, and one of them is whether it's immediate or deferred. So let's talk about that. When would you think about an immediate annuity? Some of the factors that come into play are if you're in or near retirement and you're trying to add a component of predictable income to your retirement spending plan, an immediate annuity might make sense for you. If you're worried about outliving your savings, that's a reason why a lot of people, purchase annuities so that they have that element of predictable income that's coming in. If you want your spouse to be able to receive a certain amount of money after you pass away, an annuity is another tool that's available to you because you can set the payout schedule so that it's for your life or for your life and that of another, typically your spouse. So it's something that, can be an important component of your retirement balance sheet and portfolio. But you might be thinking about a deferred annuity if you have time to accumulate assets. So someone who has a longer term investment horizon, it might be 15 or 20 years before they're planning to retire, they might think that a deferred annuity is a good way to save. And it can be, especially if you are maxing out contributions to your 401k at work or similar employer-sponsored retirement plan, and to your IRA. If you have contributed $23,000 plus the catch-up provision if you're over the age of 50 in your employer-sponsored plan, if you've contributed the $7,000 that you can contribute to an IRA, so a total of $30,000 with the potential for those additional contributions. If you've already contributed that much, you might want to think about, other tax advantaged ways that you can save. You might also have taxable investments in a brokerage or other investment account. But annuities are another way that you can diversify your portfolio. And particularly if you have a diverse portfolio, you have other investments, that's something that, can be beneficial. If you're a potential target for litigation, in many states, annuities are protected from third-party claims against your assets. So talk to a lawyer, talk to a tax professional about whether a deferred annuity makes sense for you or an annuity at all, what immediate or deferred. Types of annuities. I said that there were a couple of different types, fixed, variable, and indexed. And let's go through each one by one. With fixed annuities, this is a contract where the insurance company pays you a fixed return. It typically will spell out exactly how that rate of return is calculated. It's usually an interest payment. And it might be connected to the rate that's set by the Federal Reserve Bank, or it might be some other rate. LIBOR used to be the benchmark for a lot of annuity payments. But you should know, and you should check your contract to see what that rate is when you first enter the contract, for how long that rate will apply. Because even though the contract says it's a fixed annuity, the way the interest rate is calculated typically changes over time. So there's a period of time at which the initial rate is fixed, and then it will be adjusted according to how interest rates have changed, how inflation is, all those kinds of economic factors. And so you need to know that that can change. I have gotten questions from people who have had straight fixed annuity contracts with their insurance agencies saying, how is it possible that they're able to change the rate? And the answer is that it's spelled out in the contract. And so you need to read the contracts to make sure that you understand them. But one of the features of a fixed annuity is that it's not subject to the fluctuations or the volatility that you often see in our securities market. So we all know that stocks can go up and can go down and can go back up and can go back down. And in some months or years, it feels like a roller coaster. There's no guarantee. But with a fixed annuity, depending on how the rate is calculated, you will be getting that rate as specified in your contract. So they tend to be considered more safe than other types of annuities. There are variable annuities. These are more complex, and as the name implies, the rate of your return is going to vary with the performance of the investments that you choose. There isn't any guaranteed return, and you can lose money if the investments that you choose lose money. Variable annuities typically involve an accumulation phase, where you're making your purchases and you're dividing, the premiums that you pay across a variety of different investment products. They're called separate accounts. And there may be a fixed return component. So one of the choices may be a fixed element. But during the accumulation phase, the idea is that you're continuing to contribute money and then allocating it across these different types of assets. But there's also a distribution phase, and that's the annuitization moment where, once you start taking money out, your ability to cash in the policy goes away almost certainly. Withdrawals are typically limited. Now, that can sound like a very frightening thing, but one of the features that most variable annuities will offer is a guaranteed death benefit, so that if you pass away, your heirs will be able to collect some of the premiums. Because the concern, and when you think about, home or auto insurance, right? You don't get that money back. You get the protection on your house if something happens. But it's frightening to think that I'm buying this insurance product, but if I die tomorrow, that money's gone. My heirs won't have anything. But again, most variable annuities do have those death benefits that are involved. And indexed annuities are kind of a complex hybrid. You've got the characteristics of fixed and variable annuities. It's one of those things where they can be very confusing. They're sometimes called fixed indexed. They're sometimes called indexed. They're sometimes called equity indexed. It can be a little bit confusing. But they have a little bit of both of fixed and variable annuities. So you usually get a minimum guaranteed interest rate, and you get a level of return that's linked to a market index. The protection that you get is usually the downside risk. So, if there are losses, you're not going to lose all of the premiums that you have provided. There's a protection for that. Usually it's about 87.5%. And the interest rate, again, is set by contract, kind of like the fixed annuities. On the flip side, you have limits on your upside gains. So you've got downside protection, but you've also got upside limitations. And you can lose money depending on how your particular contract is structured and what the nature of the investments are, how exposed you are to those investments, and whether there are any kinds of limitations on losses. Equity indexed annuities, these indexed annuities are super difficult to compare. When you've seen one contract, you have truly seen one contract. And like variable annuities, they can have a variety of features associated with them, and that just adds to the complexity. So when you're thinking about gains with respect to an indexed annuity, dividends that, in like a mutual fund or an exchange traded fund, you're able to accumulate dividends and that can help your money grow. With indexed annuities, those dividends are excluded. And there are also, you need to know about the different ways that indexing works. There can be what's known as a participation rate. So you participate in a certain amount of the upside. And there can be a cap to the upside, right? Like it might be that the market has increased by 20%, but you can only participate in a certain percentage of the total amount and up to only 5%. So, again, you get limitations on your losses, but you get limitations on your gains. And then, of course, there are always fees, and these are often described as like the margin, the spread, asset costs, things like that. Take a look at your contract and make sure you understand all the fees that you will be paying. A little bit more on losses, because I don't want to overemphasize the potential for gains. If you try to take your money out early, you will have to pay an early withdrawal fee. There might be a time specified in your contract. And before that period of time, and it can be very far out, you're not going to get everything back. There can be surrender charges, for cashing in your annuity. There can be a tax penalty if you're before the age of 59.5 when you start withdrawing from the annuity. And again, for some, the market index will decline. Indexed annuities, kind of like fixed annuities, are typically not considered securities, but there are some that are. And I've got a quote here from the Securities and Exchange Commission's Office of Investor Education and Advocacy, which has a fabulous brochure on equity indexed annuities, fixed index annuities. And some of these annuities, particularly those that are securities, specify that investors may lose money if the market index goes down in value. These are often known as registered index-linked annuities. So most index annuities are not considered securities, but if the indexed annuity is packaged as what's known as a RILA, a registered index-linked annuity, it is considered a security. And the way these particular products kind of help with loss management, you can still have losses, but they help you with loss management. They either have a buffer or they have a floor. And the RILAs that have a buffer will be called buffer annuities. But in any event, the red line that you see on this chart shows the market drop. And in the first instance, let's say there's a market drop of 15%. If you've got a 10% floor, that means that your losses will be limited to 10%. You've got some protection there. There was 5% more worth of losses, but that's where you are. But if you have 15% of losses, but a 10% buffer, then your losses are going to be limited just to 5% because the 10% buffer protects you against the full extent of the market loss. Now, if the losses are more dramatic than the floor or the buffer, than the 15% loss, then you see different behavior happening, right? You see with a 30% loss, sorry, I'm losing my mouse, 30% loss, with the buffer, you're still going to have that 10%, but with, with the floor, I misspoke, with a gray line. With the floor, it's still going to be that you're protected at a 10% loss. But with the buffer, which served you so well when the loss was 15%, it's not going to protect you quite as much. It still protects you by that 10%, but you're still going to have a 20% loss. I hope that makes sense. This is super complex, but it's important that you understand how these products work. If you do have that kind of loss prevention, it doesn't mean that you're not going to lose money. It might mean simply that there's a limitation on your loss, and that limitation doesn't always work the same depending on the extent of the loss within the choices that you've made in your annuity. So as I said, the SEC has really good information about RILAs that goes a little bit deeper than what we can possibly do on this webinar, but I wanted to share that with you so you're aware of it. I mentioned the SEC because the SEC regulates annuities. The SEC and FINRA, my company, regulate variable annuities and RILAs, but we do not oversee fixed products, those very straightforward contracts, nor do we have any jurisdiction over the indexed annuities that are not otherwise RILAs. They're not otherwise registered with the SEC. But there are other regulators who come into play, and I'll give you the contact information for the state of New Jersey so that you've got that. State insurance regulators oversee all types of annuities, and state securities regulators, depending on the state law, they, like the SEC and FINRA, will oversee variable annuities and RILAs. And depending again on the state law, they might even have more jurisdiction or possibly less. All of the regulation of insurance in some states is in the state insurance regulator rather than the state securities regulator. So what do you need to think about when you are thinking about annuities? I'm going to emphasize again this limited access to the premiums that are paid. The whole idea is that annuities allow you to create a steady stream of payment so that you have income for a set term of years or for your entire lifetime, or your spouse has it for that same period of time. That can be a risky prospect for the insurance companies. And so once you have started to annuitize, you typically can't get access to the premiums that you've paid or the earnings that those premiums have garnered. And if you're in the accumulation phase, if you've got a deferred annuity, any withdrawal typically involves surrender charges. So you have limited access to the money, unlike other types of withdrawals. There's a question, by withdrawals, do I mean early withdrawals? Yes, I do mean early withdrawals, and thanks for that clarification. There can be, when you annuitize, that's the way that you take money out. But there have been people who have had financial hardships who look to their annuity and think, well, I'm going to cash out some portion of it. And that's considered an early withdrawal. And that can happen, beyond the in some contracts, even when you're in the the decumulation phase, the annuity phase, you can sometimes take out more. That's rare. But that would be another type of withdrawal. So some of the other things that you should be considering is that there are often these guaranteed withdrawal riders. So these are benefit riders, which are clauses to a contract that are, they're considered riders because they're sort of added on. But sometimes they're framed as, guaranteed lifetime withdrawal benefits so that, you can actually take a withdrawal during accumulation. So you wouldn't be subject to the surrender charge if you've got that kind of lifetime withdrawal benefit that you're allowed to take out. It might be up to a percentage of the percentage of your investment. And depending on how much you take out and when you take it out, it might delay the distribution phase, the actual annuity phase, where you've annuitized the corpus of all of your, contributions and earnings. And there are other things like a guaranteed minimum withdrawal benefit, which it kind of protects your annuity's highest value. So it's sometimes known as like a benefit base or a high watermark with your annuity. But if there's a down market, you are able to protect that highest value while still allowing the underlying investments to grow during an up market. So it allows you to withdraw a certain percentage of funds, and it allows you to do so regardless of market conditions. Now, one of the realities is that if you've got these kinds of riders and they're increasingly common, you typically pay something. So it's going to lower sort of the returns that you might have or increase costs that come out of pocket. Other types of features that you might see are a lifetime income benefit, and that's pretty common with variable annuities. And with that rider, the insurance company guarantees that you'll receive regular income payments from the annuity, whether it's monthly, quarterly, or annually, and they'll continue for the rest of your life, even if the actual balance of the annuity is fully depleted. So that can be, a benefit, but again, it comes with a cost. There are other, guaranteed minimum accumulation benefits, cost of living adjustments. Again, there are resources that the Securities and Exchange Commission have and that state securities regulators and state insurance regulators will have that will describe all the alphabet soup of the different benefits that you have. But if you're worried about outliving your money and you've annuitized a portion of your portfolio, that kind of lifetime income benefit can give you some certainty that you're not going to outlive your assets as long as the insurance company stays solvent and assuming with the certainty that you will be paying for that benefit in some way. So when you're thinking about investing in annuities, you want to make sure that you ask, have I maxed out my other tax deferred vehicles? I can't give investment advice, but there are advantages. There's sort of a hierarchy of like when it makes sense to be invested in different things. And if you have access to a 401k at work or an IRA, it can make more sense to max out those contributions because not only are you getting tax deferred growth, but you're also lowering your taxable income by virtue of contributing to those savings vehicles. And so if you haven't maxed out those vehicles, it might make sense. And again, talk to your investment professional, talk to your tax advisor. But it might make sense to max those out first before considering purchasing an annuity. Um, do you have income from other sources? Some people are quite fortunate to inherit, right? And they have income through an inheritance, or they have a stream of income from their family, perhaps a spouse or partner's pension, your own pension. That's critical. What is the surrender period? If you want to, say, I'm ready to get my money back. A, is it possible? And B, over what period of time will you be paying surrender charges? And is there a point after which there isn't a surrender charge? What features are you getting? Do you need those features? Do you want those features? Sometimes with complex products, there are a lot of bells and whistles, and you really only need kind of one whistle, right? Or two whistles. You don't need all of them. And so just make sure you understand what you're getting, and then of course what you're paying. What is the cost? Um, and if you have a chronic disease, if you have a very short time window, God forbid, you've been given a terminal diagnosis, right? You're not going to live for more than a couple of months, then purchasing an annuity might not actually be the best way to provide for your heirs, even with a guaranteed benefit. But talk to a lawyer, talk to a tax professional to confirm. So I want to talk for a brief moment about annuity exchanges, because FINRA, as a regulator of the financial services industry and the brokerage industry, we've taken action against brokerage firms over the years. There was a period much earlier when they seemed to be much more prevalent, but the sort of misselling of 1035 exchanges was happening. And that was the idea that you have an annuity contract, and you want to exchange it for one that has different, maybe newer features that weren't available when you first bought your annuity. Now, the IRS allows 1035 exchanges. They're perfectly legitimate. And the idea is that you can exchange an insurance policy or an annuity contract for another one without having to pay tax on the income and the investment gains that you earned on the original contract. And that's, again, it's allowed for under Section 1035 of the IRS code, which is why these things are called 1035 exchanges. But they must be like for like. You can't exchange a fixed annuity for a variable annuity. You can't do a universal whole life policy for a universal variable life policy. It's, you have to do like for like. And, the benefit is that if there are features in the new contract that are helpful to you, maybe the death benefit of your old contract isn't as generous as the one available in this new contract, and that might be appealing to you. But just make sure that it makes sense for you. So are those additional features, whether it's, a bonus credit or some sort of, amount of money that the firm pays towards your premiums, is it worth the cost? You have to do that cost benefit analysis. And what features are you losing? There are often annuity contracts that, insurance companies don't write anymore. Before the financial crisis in 2008, 2009, there were equity indexed annuities that performed quite well because of the loss prevention that they provided when the market dropped so precipitously. And this is all now 15, 16 years ago. But those annuities, you won't find one like that now on the market because they were expensive for the insurance companies. So just be aware that you might lose features in addition to the gains. The gains are often the selling points, but what do you lose? And it might just be that you're paying more money, or that you are actually losing a benefit that you valued and previously had. But in many instances, the surrender period restarts. And so, you might have been past that period where you were going to have to pay fees for withdrawing your money early or cashing in your contract. But that clock might start ticking again, and typically does start tipping again if you exchange your contract. And then, of course, there's new charges that you have to pay. So think about all those things. I also want to go back to variable annuities because there are some additional points that are really important with respect to those types of securities. They're often compared to mutual funds, but they're actually really different from mutual funds. And they typically have higher fees and expenses than mutual funds. Um, Things like mortality and expense risk charges, which are charges that the insurance company imposes to cover the guaranteed death benefits that they offer you. And they might have additional charges on payout options that provide guaranteed income for life. So those are features that sound attractive, but ultimately you're paying for those features in some way. And what you want to know is how and how much, and how much can that eat away at your overall returns. There might be administrative fees, and that's things like record keeping or mailing out information, underlying fund expenses on the sub accounts. These things are not mutual funds; they're technically called sub accounts. But that can involve uh, just the management fees for those investment vehicles, and those can be higher than mutual funds. And then if there are other special features, you're typically going to be paying charges that relate to each of those features. So the most important thing that you can do is check out the insurance company, because remember I said that sometimes your ability to have that guarantee is really only as good as the promise the insurance company makes, and the financial soundness of the insurance company is a critical consideration as to whether or not that insurance company will be able to pay you the annuity payments that they promised to you or to your spouse for the period of time that they said that they would pay them. So you want to know how strong the insurance company is, and you can check its credit rating. The Securities and Exchange Commission oversees what are called NRSROs, which are nationally registered securities rating organizations. And these are agencies that actually register with the Securities and Exchange Commission to provide this kind of feature. You'll be getting a copy of the presentation, so you don't have to worry about like, how am I ever going to find this page? We do have the URL for it, but it's on the SEC's website, and you can see whether the insurance companies, what the credit rating is that they have. And there are a number of different raters, Fitch, AM Best. I can't recommend one over the other. You want to see which one is providing a credit rating on the insurance company that you're working with. My top tips, I don't see any other questions, so I'll move on to the top tip section. If a financial professional is recommending that you purchase an annuity, go ahead and check them out. We have a tool on FINRA's website called FINRA Broker Check. It's available 24/7, and you can check out financial professionals. Here I've typed in the fictitious name of John Q. Broker, and you see a number of different cards that are available. Here's our guy, okay? And the fact that it's blue, it means that this John Q. Broker is currently registered, okay? So is John FX Broker, but not the same. It'll give you the name of the firm, the address, and what's called the Central Registration Disclosure Database number. So every firm has a CRD number. Every broker that's registered with FINRA has a CRD number. And you can get more information about the firm by clicking on a button that says detailed report. But if you see a gray card, that means that the person used to be registered either with the SEC or with FINRA, but they're no longer registered. And that means that they're no longer supposed to be giving investment advice for a fee that's customized to your circumstances as an investment advisor, nor are they registered to sell securities. And to be able to sell securities in the United States, you have to be registered with FINRA, and the firm has to be registered with the SEC. If you see a red card, this is a warning sign. This means that the broker has been barred. It's really important, even if you're working with an insurance agent who is not required to be a broker or an investment advisor, they're able to be registered with the state as an insurance agent. It's a good idea to check your financial professional in BrokerCheck, because we do see that some people that are barred from being a broker dealer or from being an investment advisor often move to a different segment of the financial industry. What you can do then is get information from BrokerCheck about the professional. But you can also get information from the state insurance division. And there's an organization called the National Association of of Insurance Commissioners, NAIC, where you can get your state insurance department. And in New Jersey, it's the Department of Banking and Insurance. And I've got the web pages where you can get information on contacting that unit. And you can also, of course, reach out to the New Jersey Bureau of Securities, which is part of the Division of Consumer Affairs within the State Attorney's General Office. So different units of New Jersey government. But again, you've got the information available where you can check out the insurance. We have a question: is it possible that my annuity will be traded to another insurance company with a lesser credit rating? That's always a possibility, especially if the insurance company is acquired or goes out of business. Its assets could well be taken on by another insurance agency. It might have a higher rating, it might have a lower rating. And if you're working with a broker on an investment, an annuity investment that is a registered security, like a variable annuity or a RILA, when the broker dealer goes out of business, there's a process that's operated through FINRA and through the SEC, but it involves what's known as the Security Investors Protection Corporation. And that organization sort of works with FINRA on the orderly unwinding of broker dealers that go out of business. So, it's possible that the asset will be taken on by another firm. It's possible that it isn't. And if there is a bankruptcy, that could have implications. So let's talk about tips when you're considering annuities, because I just want to remind you, you want to focus on your goals. Think about what your financial objectives are. Why are you thinking about purchasing an annuity? Is it the accumulation element that you want to save for retirement? Or is it more that you're at a point in your life where you want to make sure that you've got that, guaranteed stream of income, even with the potential for loss? How much loss can you take on? What is your risk tolerance, right? If you're unable to sleep at night, if there's any volatility in the markets, then having a market-linked product, whether it's a market-linked annuity or even exposure to our capital markets, might be more risk than you're capable of bearing. You might not have very many assets and you don't want to expose them to volatility risk. That's perfectly fine if that's who you are as an investor. My point in emphasizing your goals is that your goals are likely to be different than your neighbors or a distant cousin or some celebrity that you follow for financial advice. Your age, your health, your income needs, the combined family balance sheet, intergenerational, and just you and your spouse all make a difference. I mean, do you have to take care of a child with disabilities? Are you caring for an elderly relative? Does your spouse or do you have a chronic condition that requires medical costs? If that's the case, tying up money in annuities might not be appropriate, but annuitizing some portion of your portfolio might be appropriate. Again, it all comes down to your financial situation, and talking to someone like a broker or an investment advisor, like an insurance agent, can be helpful, but just make sure that you stay diversified. The best way to manage risk, you can buy it like buying an insurance product. You can hedge it with really risky strategies like trading options and other things. But the kind of classic way for investors to manage risk is by diversifying their assets, spreading out the different money that they have across different asset classes and even within different asset classes. And again, be sure that you understand costs. Please provide email, website, phone number. We'll do that at the very end, the very last screen. We'll have that. And if it doesn't, I'll make sure that the one that I send to Rebecca for distribution does include our information. I do want to share some resources because this, again, is where you can get information on how to contact us. We have a website at FINRA, finra.org/investors, and we've got a ton of information on it. Articles that we publish from time to time called Investor Insights. We've got tools and calculators. We also have BrokerCheck, and that's a fabulous tool that I commend to all of you. If you're interested in investing in exchange traded funds or mutual funds, we have a fund analyzer that allows you to see the impact that fees and expenses can have over time on your investment. And it also allows you to calculate and compare the fees and expenses that you'll have. We have, like I said, the Investor Insights with the latest updates, crowdfunding, subordination agreements, T+1. There's a new settlement cycle that's going to be going into effect in a couple of months. Basically, securities are going to be closed out. They're going to be settled within a single day, which is pretty awesome. But there's also core content that talks in depth about this. And I'm realizing that I've got a Q&A screen, but that I don't have the contact information. But as I promised, in the version that I'm going to send to Rebecca to be distributed to everybody, you will have the contact information. So again, I thank you for your attention. Are there any additional questions that people have? Fantastic. I appreciate your attention.
Gerri, there is another question. Are annuity death benefits limited to the spouse? Can the benefit be extended to children or nieces, nephews?
I will have to defer to the contract. I am not aware that there's a prohibition on extending benefits. I think they're typically spousal benefits, but I don't know. And I don't want to give you a wrong answer. And how much by percentage of principal is paid out in a death benefit situation, that's absolutely governed by the terms of the contract. So that's gonna vary from contract to contract.
Okay, and Fred has said, thank you for an excellent and understandable presentation for a complex topic, which I also would say that's true.
Well, thank you.
Now you have another question.
I have another one. Let's see. Are tax professionals who specialize Are there tax professionals who specialize in vetting annuities as a third party? I don't know, but that's a good question to ask any tax professional that you're considering working with. Because I mean, it's always a good idea when you're talking to a financial professional to ask them, what kinds of services do you provide? And be aware that different types of financial professionals, there'll be some services that other professionals in their category provide, but they don't. And some of them specialize in esoteric types of services. So find out from the professional what they actually provide, because that's the best way to learn. I'm going to try to pull up another presentation and show you the contact information that we should have, but my computer is befuddling me. Ooh, this one, I'm just seeing the first couple of words. I'm thinking, uh-oh, hypothetical. As a regulator, again, I can't give investment advice, and hypotheticals are one of those things that we always try to avoid. But let me see. If I put $1 million into a fixed annuity, what percentage on average does the insurance company take off the top? Is this spelled out in the contract? It will be spelled out in the contract. And I don't know, I'm not an insurance regulator. I don't know what the standard is for fixed annuities, but the consumer information team at the New Jersey Department of Banking and Insurance might be able to give you a range. So I strongly suggest that you contact them. And as I said, it'll be in the presentation that we distribute.
Okay, if there are no more questions, thank you very much, Gerri, for a wonderful presentation.
Happy to
As
be
Fred
here.
said, on a difficult subject, yeah.
Well, have a wonderful evening, and thank you so much for having me.
Okay, good night, everyone. Thank you.
Good night.